What is a Roth IRA and how you can use a Roth IRA to build wealth? On this episode of Through the Pines, we'll discuss all things Roth IRAs, including Roth versus traditional IRAs. What is a backdoor Roth contribution? When can you do a Roth conversion? What is a MEGA-Backdoor Roth? Does your 401k allow Roths? 3 money types in a Roth IRA? And what is the 5-year rule when it comes to Roth IRAs? Welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while rollerblading the Newport Beach Boardwalk. This is Through the Pines. Our advisors for this episode, welcome back, Rex, Baxter, and Brandyn Smith. Our advisors, they are the 2023, 2024, and 2025 Forbes Best in State Wealth Management Teams for Utah, Advisor Hub, fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award. You can find them at planwithbaxter.com. Rex, thanks for being here.
Hey, thanks for having us. We're excited to discuss to Roth or not Roth.
to Roth or not Roth, yes. I don't know, Rex, do you want to, before we decide to Roth or not Roth, why don't you just tell us what a Roth is, like the basics. Like, what is a Roth? When did it happen? Why do we love them?
So Roth came about, there was a Senator Roth, and back, I don't remember, late 90s, I want to say, he passed a bill which turned into a law that allowed after-tax, tax-free contributions into Roth IRAs, and then that kind of advanced into Roth 401ks.
And this grows tax deferred.
So this grows tax free as opposed to tax deferred.
Yes.
But there's a lot of nuances. There's a lot of confusion.
But we should still build a statue for Mr. Roth because this is brilliant.
I'm pretty sure. I'm pretty sure at the top of the Rocky Mountain there'd be Rocky, and then a little bit smaller stature maybe Roth.
For Roth, this is a big deal. Okay, so but what's the confusion?
Well, there's a lot of confusion. As you know, we get questions all the time. The first confusion is what is a Roth? How does it work? The second, very next question is, well, should I do that? Is that good for me? And that's what we're going to cover today.
Okay. All right. So, Brandyn, let's get into the weeds a little bit. There are Roth IRAs, which at this point are not new anymore if they've been around from the 90s, 30 plus years old. But everyone has probably heard the word IRA, traditional IRA. What are the differences between a traditional Roth IRA and a Roth IRA, or traditional IRA and a Roth IRA?
Yeah, great question. Going back to almost the beginning of it was you could have an investment account called a non-qualified investment account. And that's just like the most basic of investment accounts, right? You put as much money as you want in, you pull it out whenever you want, and whatever grows, right? So let's say you put $1,000 in, it grows by $100, you pull it out, you're going to pay taxes on that growth. And then the government said, well, tell you what, since you're, United States citizen, we'll let you open a traditional IRA. And this traditional IRA will be for your retirement, but there's a catch, right? That's the catch. You can't get to it until you're 59 and a half years old.
Right. Well, you can, but there's penalties.
Correct.
Okay.
Right. However, if you use this, we'll allow you to take a tax deduction. So you can literally, with a traditional IRA, let's say you get to the end of the tax year, you made $100,000, you put $5,000 into a traditional IRA, it looks like you only made $95,000 that year. That comes off your highest marginal tax bracket and can really help you if you're having tax issues, right? If you're paying a lot of taxes, fund a traditional IRA, and essentially all that does is defer that until when you pull it out in retirement. So a perfect way to think about that, like let's say you're in your late 50s, early 60s, you're in the highest tax bracket of your life, and you're like, man, I'm paying all this tax every time I earn money. I sure wish I could just kind of like defer this until I'm in retirement and in a lower tax bracket. Well, a traditional IRA or a traditional 401k contribution will let you do just that. You make the contribution, you get a tax deduction, you get tax deferred growth, so you're not paying taxes as it grows. But then as you pull that out in retirement, it's taxable to you as income. And so that's kind of what that was like the foundation of IRAs and retirement plans.
And how long has a traditional IRA been around, would you say?
So they came about back in the 70s. So as pension plans were starting to wind down and become a little bit less prevalent in society, then the Congress and the government came up with 401k plans, defined contribution plans, and with that, IRAs. Now, originally, IRAs, and I don't remember exactly the amount, but if I remember correctly, it was about $600 a year that people could put into an IRA. And then he eventually graduated to $2,000 a year, and then where we're at today at $7,000 a year is where we're at. The incentive was to try and encourage the middle class and below, to give them incentive to save additional funds for retirement, because they had the Social Security program, and up until that point they had their pensions, and then they had whatever the personal savings were. But as pensions were starting to wind down, they needed to incentivize the population to do some additional saving to try and replenish the retirement income that they may lose from those pensions. And so back in the 70s, that's kind of where that started. It kept that way until, again, in about the 90s, they started increasing those limits. And in recent history, they've now started to increase those limits every other year, kind of tie those in with inflation.
Yeah.
So before we enshrine Senator Roth, there's kind of, you look at it and you say, wow, this is a great tax break for the investor, because now they can invest and get this tax-free growth. However, essentially all they're doing is, instead of giving all these tax breaks up front, they're taking the tax money, right? You don't get a tax advantage. So going back to our example of funding a traditional IRA and getting your deduction, with a Roth IRA, you don't pay extra tax, but you don't get a tax deduction. So going back to that example, let's say you're making $100,000, you put $5,000 into a Roth IRA, you'll report that on your taxes, but it won't change a thing, right? You just put that $5,000 in, you're not getting any tax breaks. The benefit, though, is it grows tax-free, and you pull it out in retirement completely tax-free. And so people ask us all the time, like, well, which one is better, right? Yeah. And people use examples of, would you rather tax the seed or the harvest? And it's a horrible example, in my opinion, right? Because the way the math works is, let's say you're in a marginal 22% bracket today and a marginal 22% bracket when you pull it out in retirement. Which is better, traditional or Roth? Literally doesn't matter, right? If you and you can run the math on that, right? It's just simply, if you take 22% off the front end and you grow it tenfold, and then you compare that to just growing it tenfold and then taking 22% off the back end, the net after tax amount of dollars you pull out is identical. And so when you're making the decision, do I do traditional contributions or Roth contributions? It comes down to, what tax bracket am I in today? And that's easy, right? We can calculate that fairly easily. And then, what tax bracket do I think I'll be in retirement? And that's difficult because we don't know future tax rates. We don't know, growth rates and retirement scenario. I mean, there's a lot more variables in that. And so, but what we can do is we can sit down with clients and we can project what we think it is based on their current savings rates and based on their current tax rates and where we think things are going to be in the future. And we can come up with a fairly educated guess. Does it make more sense to take a tax deduction today, or does it make more sense to postpone that and get tax-free benefits in retirement?
Yeah. So Senator Roth created another tool in addition to a traditional Roth IRA to help you build wealth, depending on what it is that you want to do. Rex, is there ever a time when you use both?
Sure, absolutely.
Yeah.
Yeah. Sometimes we'll use both if somebody's starting to phase out, if we're trying to, some personality types want a balance. They want choices in retirement so that they can take some, taxable pre-tax money out of the IRA, and then they can stay within a tax bracket by pulling from the Roth. And so they're still meeting their income needs, but between pulling tax-free money and taxable money, they can kind of control which tax bracket they're in. So people a lot of times will do both.
Okay.
A couple rules of thumb, and this is not tax advice, right? You really need to have a conversation with your financial advisor, your tax advisor, where you look at your individual situation. However, rules of thumb, if you are young and not making very much money yet, and in a lower tax bracket, a Roth contribution makes so much sense usually, right? We're not trying to get a tax deduction. Let's just save the money. We grow it tax-free. It's tax-free in retirement. And so those early years, Roth IRAs make so much sense, or Roth 401k contributions make so much sense because you can amass a huge amount of money that will be tax-free to you in the future, and you don't really lose a whole lot, right? Because your federal bracket is so low. Another fairly easy slam dunk scenario is people when they're in their late 50s, early 60s. They're a lot of times in the highest tax bracket of their life. And man, if we can just defer that 5, 10, 15 years, we can pull it out in a lower tax bracket depending on how much savings. And so if you find yourself, later in retirement, you maybe haven't saved as much for retirement, you're in a really high tax bracket, married filing jointly above $123,000, give or take, right? Then it might make sense to do a traditional IRA contribution or a traditional 401k contribution and take that tax deduction, which allows you, because you take that tax deduction, it allows you to save more. And so that's kind of the trade-off, right? We don't want to just do 10% Roth or 10% traditional. It's if I do 10% Roth, I could also do 12% traditional and be the same net after the check, right? Because your payroll is actually going to look through that and say, oh, if you're doing a traditional contribution, you're not going to pay as much in taxes, and they'll actually withhold less. And so if you do, like, for example, if you've got a Roth IRA that you're saving 10% into, and then you say, hey, I'm going to switch over to a traditional IRA or a traditional 401k, you'll see in your payroll, you'll actually get a raise. Because you're actually saving less. And so we'll help clients kind of calculate that roughly and say, all right, if we go from Roth to traditional, we'll save this much. And so let's increase your contribution by 1 or 2% to make up that difference. So your net check is the same, but we grow more money that hopefully we can pull out in retirement at lower tax rates.
Very interesting. What is a backdoor Roth contribution? I've heard someone talk about this, but I have no idea what this is, Rex.
So a backdoor Roth is where you may have your income is above the deductibility limits of a traditional IRA. And so, once your income hits a certain level.
Which are what typically?
Yeah, so in 2025, for a Roth, if you're married filing jointly and you make more than $236,000, you start to phase out until you get to $246,000. Once you're at $246,000, you make too much money to make a regular Roth contribution.
Married filing jointly.
Okay. Numbers for single is $150,000 to $165,000.
Okay. And then
so
Rex,
if you're making over that 200,000 plus number and you can't make a Roth contribution anymore, you're also making too much money to make a traditional IRA and deduct that traditional IRA contribution as well. And so what some people will do, and this gets a little bit tricky, and so there are some rules surrounding this that you want to make sure that you get answers to before you just listen to this podcast and run out and do it.
Sure.
But essentially, you're going to make an after-tax, a non-deductible traditional IRA contribution. So you're putting money into a traditional IRA, you're not deducting it on your taxes, and then you're going to convert that to a Roth IRA instead of a Roth IRA contribution, is what the tax code allows. And so, again, if you put $7,000 into the traditional IRA, you're not deducting it because you make too much money, so you can't deduct it. You can't make $7,000 into a Roth IRA because you make too much money for them to allow you to do that. But I can make that $7,000 after tax and convert it into the Roth IRA, and that's a backdoor way to get money into the Roth IRA.
Okay, so when can this be done? In other words, we're talking about a self-employed person, entrepreneur, a small business owner who's on the edge of the income threshold there, and then says to their financial advisor, Rex, I want to put this into a Roth IRA, but then they get their taxes back and they find out that they made more money than they thought. Now, can you convert at that time, or how does that work?
Yeah, so you have up until your tax filing deadline to make the contribution into that traditional IRA, that after-tax contribution, and then you can convert it at any point. And so we can convert it into that Roth at any point during the year. So that's easy to wait until you do your taxes, and right before you hit submit,
Yeah.
right? Then we're going to go and make that after-tax
Call
contribution
Plan with
and
Baxter. Okay.
convert it
Okay.
at that point.
Okay.
But you have up until your tax filing deadline to do that, plus extensions.
Yeah.
Yeah.
At a high level, it's just simply if you make more than that 236,000 and you want to make a Roth contribution,
Yeah.
then you just need to do that after just that IRA contribution, convert it over, and effectively all you've done is just done a Roth IRA contribution. It's as easy as that. Now the catch that you have to keep in mind is you can't have any traditional IRA assets floating out there. You can have a traditional 401k, but if you have any traditional IRAs floating out there, it makes the strategy technically not impossible, but so hard to calculate.
Like at all? Like you can't have one of
Yeah,
them?
It makes it messy. It makes it
really?
really messy. And so there's a got you out there that if you have a traditional IRA somewhere,
At another account, another broker,
Yeah,
anywhere.
wherever,
Okay.
right, at any location, and again, it's a traditional IRA that you have, then what the IRS makes you do is they make you do that pro rata, which means that, let's say you, for the sake of argument, you have $100,000 traditional IRA, and then you go and make a $7,000 after-tax contribution into a completely separate traditional IRA or the same one. It doesn't matter. And then you want to convert that 7,000, they'll let you convert the 7,000, but they're going to make you do a pro rata calculation to where they're going to say, okay, that 7,000 is roughly, 92% of your combined IRA money.
Mm-hmm.
And so 92% of that conversion is now taxable on that conversion.
So you can't cheat the system. You can't do multiple accounts and try and
you
like.
can cheat it.
Well, you can't
That's
cheat
a
it,
hard
but it
word.
does get complex.
Right.
To the point to where so some people, what they'll do is instead of having a traditional IRA, sometimes they'll even re-roll that traditional IRA back up into their 401k plan. So they don't have any other traditional IRAs out there. And then it
Because the
keeps it
401k
clean.
doesn't count.
Because the 401k doesn't count in that pro rata conversion rule of the IRS.
The other thing you can do is you could convert your IRA if you don't have a large amount in IRAs. Let's say you got like an old IRA with $3,000 in it and you can't roll it into a 401k. Just convert that over to a Roth as well with the rest of it, and then you're good. But it's just this weird little thing. If you've got traditional IRA assets floating out there, it makes the backdoor Roth almost impossible.
Yeah, just be aware you would owe income taxes on that $3,000 on the $3,000 portion of that example.
Yeah.
Right.
Okay. And then, so that brings up the question of what about, and we haven't talked about this, but we will. What about people who have worked multiple jobs and have multiple 401ks, but they're Roth 401ks? How is that classified? And can, as far as taxes go, and can you have like 5 or 6 multiple Roth 401ks floating around there?
Sure.
Yeah.
Yeah, you can leave your Roth 401ks at your previous employers if you want, or you can combine them into your current employer, or you can roll those Roth 401ks into a Roth IRA. And so to me, most of the time, the most common sense thing to do is to keep things kind of consolidated and together. But you do want to look at what the fees, costs, expenses, performance are of where you currently hold it, and do that evaluation to see where it makes the most common sense to keep things. But sometimes we're doing a treasure hunt at retirement to try and find that old Roth, from
that you
from
just
when
know
you were
you have
25.
Yeah.
You're confident you didn't ever pull it out and buy a truck with it,
Right.
but you're just not sure. So
Also unsure how you got that boat in the driveway, but yeah. Well, let's talk conversions then. Brandon, when do you do a Roth conversion? I mean, we're kind of talking about it, but what are the rules here for this?
Yeah, so you can do a Roth conversion whenever you want,
Okay.
and for however much you want. However, any amount you convert will be taxable to you as income. And so if you've got this big IRA, 150,000 or 300,000 in a traditional IRA, and you're like, I'd really rather that be in a Roth IRA, and you do a conversion, I mean, there's no unwinding that. You just recognized $300,000 worth of income on top of whatever income you're already at, which puts you usually in the highest tax bracket of your life.
Yeah.
And it goes back to that what we were talking
So
about
have
earlier.
you seen that happen then?
So there's
To clients?
Yeah.
absolutely.
Yeah.
So there's 2 points that can be confusing on that, right? One, anything you convert that is pre-tax money is taxable, right? If it's after-tax contributions, again, that went into an IRA, then that after-tax money would be, a tax-free conversion. But any growth, earnings, interest that after-tax money accumulated would also be taxable on that conversion. And so you have to be a little bit careful of that. The other thing is, a couple of years ago, we used to be able to convert, and then if the market would take a big dip, we could actually at that point unconvert, if you will, or do a reconversion. So you would convert it to a Roth IRA, you would reconvert it back to the traditional IRA.
What did they allow? Like every 6 months, or how long did you have
So
to?
they allowed at the time, it was, initially when it first went through, they didn't have a lot of rules around it. But then it went to kind of once a year, once during a period of time that you could do a reconversion during that year. And so, if the market took a 20% dip, you would reconvert it back to the IRA because you don't want to pay taxes on, 100% when you could reconvert it and do another conversion at 80% and save yourself the taxes on that gap in there. And then with Secure Act 2.0, I think it could have been 1.0. I can't remember which Secure Act changed it to where now they don't allow the reconversions anymore.
Yeah.
And so once you convert,
You're done.
yeah.
Okay.
Which I don't think that was the intent in the first place, was to allow people to go back and take a nice tax break, right? The intent was, if you made a huge
Wait a minute.
mistake,
I thought the government was just being nice.
no,
I mean, that's
if you made a
just-
huge
okay.
mistake, we'll let you unwind it. And then everyone abused it. And now they're
Right.
like, yeah, all right. If you convert this huge amount, you're just stuck with it.
Right.
Which, when we go back to that original conversation, where really with a Roth conversion, it comes down to what marginal rate am I converting this at versus what rate am I going to pull it out at, tax rate, in retirement. I mean, that's the question. And so if you're doing huge conversions, usually that throws you in the highest tax bracket. For what, right? So that we can pull it out later at a lower bracket. That's going to lose us money. And so we want to be very strategic about when we do Roth conversions.
Yeah. What's the scenario where you'd want to do that?
Two really good scenarios. First scenario, maybe you're working and you have a lull year, right, where you don't make very much money, or you're unemployed for part of the year, and we're in a really low tax bracket for whatever reason. That's a great time. We can do that conversion. The catch to that, though, is we've got to come up with money, right? Because we can't withhold for taxes on a conversion pre-59.5. Otherwise, that's technically a distribution out of the IRA. And so if we've got some cash that we can use to pay the taxes and we're in a low income year, that's a great opportunity. The more likely and the more common scenario that we see is once you retire. So maybe you're retired age 65, income drops, you don't have to take your required minimum distributions, or RMDs, until age 73, and that gives us that 8-year period of time in a low bracket that we can do conversions. And what we usually will do is we'll look at your income and say, all right, we've got this much room left in the 12% bracket. Maybe we can convert $38,000 and work our way up to the top of that bracket, do conversions on that at the 12% rate, and set aside and we can build up quite a bit of good Roth money.
So you just do a little bit, convert a little bit per year until you are done converting or whatever.
Based on how much room you have in your tax brackets. Okay. We also have to take into consideration health rates, right? Like Medicare costs and what we're doing with that. Or if you've retired pre-65, right? We need to look at your health insurance and how your income. And so there's a lot of things that go into that. But what's really, really fun is we can actually amass a large amount of Roth assets at a low tax bracket, and set your retirement up with a lot more options.
This is why we work so closely with your accountant, and why you should work so closely with your financial advisor and with your accountant to run through probably a pro forma tax return in the fourth quarter of the year, because you may have a year where you have a big tax loss. You may have taken a tax loss on a business. You may have taken a tax loss on some capital gains, capital loss sales in your investment portfolio. And by running through that, we can zero in very closely on your tax bracket. We can zero in on the amount that it makes sense to do those conversions. So this is an important time to make sure that you've got a good team working together for your benefit.
Yeah. And if you're doing like backdoor Roth contributions, we want to make sure your accountant knows about it. So they're filing the appropriate 8606 form and they're aware of what's going on, so you don't have to go back and amend things. And so these Roth conversions, backdoor Roths, they're so powerful in the retirement planning world, but you just need to make sure you're checking all this stuff.
Yeah.
So this is one of those podcasts for everybody listening to it that you might not want to listen to while you're driving, because you need to have nimble fingers to make sure you can rewind and listen to this like 2 or 3 times to catch what we're saying.
Or take notes somehow.
Because this is complex.
Yeah.
These are some complex topics
Yeah.
to where you want to make sure that you're listening so that you know some of the right questions to be discussing and asking your advisors.
Planwithbaxter.com if you'd like to ask Rex and Brandon follow-up questions. Let's get even deeper into the weeds here. We're going back to like the Jurassic era. What is a MEGA-Backdoor Roth?
Megasaur.
Yeah.
So 401k plans can have a lot of really cool options inside of them. And you might ask, well, why don't all 401k plans just have all the options? And it's really up to the plan sponsor, whoever is sponsoring the plan, the employer, to decide, hey, do we want to allow employees to have all of the options? Because if you do, right, you might create more headaches for yourself as an employer. You might have an employee go in. One thing I want to discuss too was Roth conversions inside a 401k plan. Some 401k plans allow for in-plan Roth conversions, which can be incredible. I've done that myself, and it's a great strategy where you go in and you convert your employer's contribution that's pre-tax into Roth to really, really double down on that Roth side. The catch though, right, and when I did it, right, I had like 5 screen red flags like, hey, if you do this, you're going to owe a lot of taxes, and there's no unwinding it, right? And so you've got to really be confident in what you're doing. But 401k plans can allow for those in-plan Roths. Another thing they can allow is this MEGA-Backdoor Roth. And so within your 401k plan, sometimes you'll see it, sometimes you won't. But there's 3 money types. You've got pre-tax, which is your traditional contribution, which gives you the tax deduction. You've got Roth, which is what we're talking about, that you don't get a tax deduction, but it grows free and it grows tax-free, and it's tax-free in retirement. And then you've got after tax. And sometimes people call Roth after tax because they're like, oh, it's money that you get after tax. But after tax is technically different. After tax is money that you're paying you're not going to get a tax deduction for, but it's not a Roth yet.
It's not growing tax-free. The growth, dividends, interest, and growth is taxable at when you pull the money out of the 401k during retirement. And so that's different than a Roth contribution. They both go in after tax. One grows tax-free, one grows tax deferred on that after-tax contribution. And that can happen in 401k or in the IRA, just as we went through the example, to where you can make an after-tax contribution. If you did not convert that to a Roth, again, that after-tax contribution, the dividends, interest, all of that would be deferred until you pull it out. But then when you pull it out, you would pull out your, part of your contribution tax-free because you already paid taxes on it. But then all of that growth and appreciation would come out as taxable income.
Yeah.
And so that's one of those complexities that you want to make sure you understand the difference between those money types. That's important.
Sometimes when you two are talking, it's like when I was like the first day or first week in algebra class, and I had no idea what they were, talking about. So it's like you're gonna have questions, and it's because like if I was sitting down with you, Rex, one-on-one today, saying, "Explain this to me about my finances and what we should do," I'm gonna have to ask you that same question 3 or 4 times before it really. And
a lot of people ask us every year for 5, 6, 7, 8, 10 years.
Right.
Because you're trying to take a drink from a fire hose.
Yeah.
And you don't want to take a drink from a fire hose. That hurts. And so you want somebody else to kind of break it down and explain it to you.
Is an overview of the concepts. And so if you're missing some of these concepts, it's not unusual. Like this is stuff that is, there's a lot going on. And so if you have questions, they can reach out, right? Plan with Baxter.
Absolutely. Yeah. Reach out. This is one of those times where you want somebody to hold your hand when you're crossing the street.
Okay.
You want to be aware that it's available.
Right.
You need to know when to ask the questions. But then once we know when to ask the questions, we think, hey, this could be really beneficial for my plan. Mm-hmm. Then we want to work with the advisor. We want to work with the accountant, right? We bring people together and we really make sure that we're we're checking into it. So at a high level on the MEGA-Backdoor Roth, and I think this is important, how much can you save into a 401k? Well, you can save $23,500 a year. If you're over age 50, you can save another $7,500 per year, so a total of $31,000. Now, new this year is the kind of the exception.
The ketchup of the ketchup.
Right. If you're making more than $145,000 per year, then that catch-up of $7,500 has to be Roth.
Oh, sorry. That takes effect for 2026. Yeah, that takes effect for 2026.
Yeah, so
be aware it's coming up.
In 2026, if you make more than $145,000, if you're over age 50 and you're doing the catch-up of $7,500 on top of the $23,500, that $7,500 has to be Roth. You can't take a tax deduction. Kind of a weird new rule. It used to be you could choose. But high level, right? In a 401k, let's say if you're under age 50, we can do $23,500. If we're over age 50, we can do $31,000. But is that the most you can save into a 401k plan? Trick question, no. There's a 415 limit that a lot of people don't realize. You can actually save up to $70,000 into your 401k plan if your 401k plan allows it. And so that's where we have to, now not only do we have to bring the advisor, the accountant, but we have to bring in the 401k HR, right? And look into the plan document and figure out what's available. But what you can do with that is you can so you make your $23,500 contribution, and then you go in and you make additional after-tax contributions. Maybe you save another, $30,000 into after-tax, and then a lot of times they'll allow you to just immediately convert that over to Roth.
Wild. Okay.
And then that's a mega backdoor Roth.
Mega.
Yeah.
Because now we can start saving huge amounts. And if you got two spouses that both have a 401k that both allow that, well, holy cow, now we can save $140,000 a year.
Who writes the rules on the 401k? Is that the business or the
business does?
Okay.
Yeah. So there's parameters, right? You can't just go write anything, but there's parameters as far as what the IRS allows us to include in a 401k plan. And that's something we can go in. If that's not allowed, we can talk to your employer with you, right? And say, hey, these are some options. Here are the pros and cons to consider, but this could really help employees. It's not going to cost you anymore. It's just we just need to be aware of, that people can do this.
Talking about complexities, the 401k plan gets even more complex because even if they allow those after-tax, those MEGA-Backdoor Roth contributions, essentially to where you're converting and you're doing the extra $30,000 or whatever the amount is for the example, the plan may allow for that. However, it still has to go through additional testing, and in order to make sure that it's not overly benefiting the highest income earners of that company. And so there's some testing that the IRS requires and the Department of Labor requires to make sure that it's not an unfair plan that's just there designed to help the high income earners and not everybody else that's part of the rank and file. And so you may contribute it, and all of a sudden at the end of the year, you may get a refund of $25,000 of that $30,000 because it didn't pass the testing. And so this is why it's important that, again, you bring all of your advisors together between the accountant, the financial advisor, and we probably do want to have a quick conversation with somebody in HR, somebody involved at the plan sponsor at the company, so that we get a feeling for, okay, one, do you allow it? Okay, you don't. Well, can we change that? Can we talk to the committee and look at including the after-tax contribution? Yes, okay, or you have it. Great, now you have it. Are you having to do refunds at the end of the year because you're not passing testing? Can we do additional education to the employees so that they understand what a benefit it is and see if we can get that to pass the testing so that you're not getting these refunds? And so it does get very, very complex to where you want to make sure that you get us involved, and you want to make sure that we're having these conversations with you, with your accountant, with your HR people, or the company, the business owner of the company who can also take advantage of it.
Okay.
But if you're a business owner and you don't have employees, then it gets really easy, right? Then we can design a 401k plan that just allows you to
Wait, so it's just like for you?
Yeah.
It's a solo or a uni-K. We've talked about that on different podcasts, to where we can custom design a 401k plan for your benefit with your accountant. and work through that so that we can do these MEGA-Backdoor.
MEGA-Backdoor. Hey, that's a new one.
Yeah,
that sounds like a good one.
We're gonna Mac on these backdoor Roths. And
So I want a Unikay, and I want to design a logo for it for my own logo. for my own Unikay.
Are you gonna do a triathlon with the logo on your?
Yeah, and it's like they're like they'll ask questions. Well, it's like, well, it's so I can't share it. So.
Yeah, the Solo K though, you got to have a business that sponsors it. You can't just be a regular citizen that goes out and says, "Hey, I want to open a 401k," and you can't have employees. If you have employees, because that's kind of the whole. That is the whole.
What about contractors?
You can have those.
You can have independent contractors, and it can be you and your spouse, and so you and your spouse can do it.
Right.
But if you have a business partner, it doesn't work?
Nope.
Yeah, depends on how that
LLCs
structure is.
Yeah, okay.
Because and the whole purpose of that is they wanted to. They're like, hey, business owners, we will give you this really cool tax deduction of a 401k if you'll also offer it to your employees.
Yeah.
Right. And that's where you get into like safe harbor matching and how do we avoid testing and things like that. That's a lot of reasons why matching is on there, because there's added benefits to the employers if they offer matching as well. And so, again, a lot of testing, a lot of things to know. It's important to make sure that you understand what's out there so that you can ask the questions when you're meeting with your advisor and accountant.
Yeah. Very good. I think it's time for some s'more numbers.
Yeah, it is.
Ooh, yeah, I'm hungry.
Which it is s'more season, by the way.
It is s'more season. So last night I was driving home, right? And I'm in a neighborhood of all things. I'm driving in the neighborhood. It's on a hillside, if you can picture this hillside. And so there's this nice house going around a bend, and on the side of the house is this nice staggered rock retaining wall.
Yeah.
And in the middle of the retaining wall, you've got and there's no shelves, right? It's literally just a staggered rock retaining wall. And I see this guy up there. He's got, 1 foot up on one rock, 1 foot down on another rock, and there's these huge flames coming up. And he's got a stick with a marshmallow on it. And he's sitting here making us s'mores literally last night.
On the cliff.
On the side of his yard on this rock retaining wall. Now, certainly there's got to be a better place to build a fire. but so we're not recommending, to do s'mores at any cost. We would like a safe cost, but man, it looked tasty.
Yeah.
It looked good.
But we're going camping this weekend and just got these chocolate graham crackers.
Oh, yes. Yeah. No, this is the time you were talking about, because they make
good.
specific marshmallows for s'mores now, which is good. Also, pro tip, if you have a child, I don't know, I have a 10-year-old, and we buy the chocolates, but they never make it to the s'mores because he sneaks them all.
That's me.
And that's you, yeah.
Hey, I also have, I just got to throw this out here. If anyone is in charge of like chocolate making, I would love to see a waffle chocolate, right? So it has like a lot of gaps.
100%, yeah.
So that way when you smash the
100%.
mallow, it
Love
has
it.
gaps for the marshmallow to go into. And you could make it so like it goes in 2 pieces, right? So when you it's a good solid shipping size, it's solid, and then you pull the chocolate apart.
Ooh,
Yes.
What if they
And
made
you've got
like
your waffle.
What if they made like a pocket, like a pita? So it's like half circled, and then you just kind of slide the chocolate marshmallow in there, and it's already half closed and half circled, little pita
I have
pocket.
not gone down the s'mores blog, Reddit, rabbit hole, YouTube, whatever, but I bet there's some of these ideas.
Oh, we're
out
s'mores
there.
connoisseurs.
Hey,
Good.
but this was not the s'more numbers. So the s'more numbers back in the early 1940s, and this actually comes from the Bureau of Labor Statistics. First Trust put this together. 1940s, what percentage of American workers were employed in manufacturing?
In the 30s,
In the 1940s.
I'm gonna say 60%.
Damn it, you stole my number. 65.
Man, 39%. You're supposed to guess lower.
What? Oh, I thought it was really high.
I mean, you probably had some agriculture, right? You have manufacturing, agriculture, and then
Oh,
other
that's
jobs,
true. That was probably
right?
like between the two.
In the 40s, yeah,
Yeah.
a little bit higher.
was it 40s or 30s?
The 40s.
Oh, I thought
that's
it was the
what it was. I'm
30s.
sorry, I should have been more clear.
Dang it.
39. Today, what do you think manufacturing is?
Ooh, I bet
18.
it's 22.
8. It's come down
8.
dramatically. And so people see that and they
We
say,
don't make anything.
Yeah.
they say exactly that. We don't make it. Manufacturing is dead. However, over that same period, U.S. manufacturing output has surged 12-fold.
It's the droids.
It's literally 12 times higher than it was when we had 39% of our population working in it. Now we've only got 8, but we're making 12 times the stuff.
So is that
It's the robot.
Is that Henry
chart?
Ford?
It's the robots.
No, that's
It's efficiency.
Oh, you know what?
you can't see that.
Oh,
but-
almost.
there it is.
Tilt it just a
Focusing.
little.
Yeah,
oh,
there you
look
go.
at that.
There you go.
There it is.
Oh, there it is.
Yeah.
that
Nice.
is crazy.
Isn't that
Yeah,
crazy?
it is. It's
Visit the
efficiency.
YouTube channel to see the chart.
Yeah. No, it's the. It's how assembly line. I mean,
Yeah.
it's and then
Right.
and
Well, and
robots, of course, but
It's capital. It's us. We can produce. I did this whole like 7-page paper in college on NAFTA, and the North American Free Trade Agreement, and one of the most
was
interesting.
it good or bad?
Well, it was. I wasn't trying to say whether it was good or
No,
bad. It
I
was
was
just.
curious.
But one of the most interesting things I found is that when we freed up trade with corn, American corn flowed into Mexico. We can make corn cheaper than Mexico can make corn. And you say, well, why is that? Our labor's so much more expensive. It's because we have these massive tractors, and the efficiencies of those outweigh cheap labor. And it's the same thing that's going on in the manufacturing space.
Interesting.
Is that when we have enough capital to put into it, you make the productivity of each laborer so much more.
Interesting.
Speaking of corn, have you ever played Pit?
Yes,
Yeah,
when I was
course.
younger. Yeah.
I love that game.
Yeah,
Okay.
corner
good
on the
one.
corn.
Yeah. Yeah. If you haven't played Pit, and it's any like kids can play it like as young as 10, whatever,
Right.
8 even maybe, but it is a trading game, and most kids don't know that until they're older. And like, oh, it's literally a trading game.
Right, we're
Of-
trading
on commodities.
trading
Yeah.
commodity futures, agriculture
Right.
futures.
Maybe not futures.
And you don't want to go. You don't want to go out with the bear
Yeah. Yeah.
I forgot
or
about that.
the bull. Really, if someone else, if you're holding the bull and someone else wins, then you do want to go out with the bull.
Yeah,
So,
you do want to end the game with the bull.
Anyway.
I read another interesting stat, and it's not dealing with production and things like that, but another interesting stat that I read this week was that almost 40% of the adult population in the United States has more credit card debt than they have retirement savings.
What?
Yeah.
Ooh, is that like no matter the age, it's just a general
Adult population, so
like
18 and older.
plus. Oh, wow.
18
but
and
that
older.
includes people who are
That
retired
includes your-
even?
yep.
I mean,
Yep, the adult population. So that includes your 70-year-olds. That includes the adult population. The 40%, well, it's not quite 40%, it's 37. 37% of the adult population has more money in credit card debt than they have in retirement savings.
That's a problem.
That's why we're talking Roth IRAs and savings and traditional IRAs. We are single-handedly trying to change that curve.
yeah, Rex, how the hell did that happen? Like
How did we start to change the curve? By starting the podcast.
Well,
is that what you're asking?
how did we get there?
How did we get to 37%?
Yeah.
I'm not sure when the credit card was invented. I'm not
Yeah.
sure how that started.
I know Klarna's
That's a
helping
problem.
right now.
That's a problem.
I mean, the issue there, in my opinion, I haven't looked at all the in-depth of those numbers. The issue there is just lack of retirement savings, right? Because credit card debt is more or less capped.
You could technically have $5,000 in credit card debt
Right.
and zero
in retirement.
retirement.
I
So,
think the
yeah.
issue there is you're going to have to wait for our next podcast where we talk about balance.
Right.
But I think the problem is balance. It's focusing on too much
Yeah.
spending today versus saving for tomorrow.
Yeah, we're going to fight on that one. All right, Brandon, wrap us up here. What is the 5-year rule?
Yeah, good to keep in mind. So, and again, not giving tax advice. However, with a little known fact about Roth IRAs is when you contribute to a Roth IRA, you can actually pull your contributions out tax and penalty free prior to age 59 and a half. So not the earnings, but whatever you contributed into that Roth IRA. And so people started getting smart, and they're like, well, what if, because on a traditional IRA, that's not the case.
Mm-hmm.
On a traditional IRA, you make that contribution, you pull it out, you get hit with all the tax, and then you get hit with a 10% penalty on top of it. And so people thought, well, what if we just convert to Roth, pay the tax, but then we pull out our contributions tax-free? And that can't be done. You need to have that Roth IRA in force for at least 5 years.
So it can be done, but you got a 5-year wait time.
Kind of stops people from last minute doing those conversions and pulling
Okay.
money out. So
Okay.
so be aware of that 5-year rule and make sure, again, you're working with your accountant and advisor.
Some people were using that 5-year rule as their emergency fund. And so they would make a
Oh,
contribution
really?
into a Roth IRA, a contribution, right? And then they would let that grow tax-free. And then if they needed money for an emergency, they would go and invade the corpus or their contribution of the Roth.
Wait a minute, I'm thinking initially that's not the worst idea.
Fund.
What would be bad about that?
There's not real. Well, one is are you fooling yourself that you're saving for retirement when really you're using it as a checking account, right? Coming in or out. The other is you need to make sure how your custodian, the person that's holding the money, separates out the distributions, the money coming out, as just contribution versus a combination or pro rata of contribution and growth. Because some custodians require you to pull out growth and appreciation, dividends and interest first before you can pull out your principal out of the Roth. And so you need to make sure you understand the distribution rules of whoever's holding that Roth.
Yep.
Okay, Brandon, anything else on Roth IRAs?
That's it. I think they're an incredibly powerful tool. They are not necessarily the best in retirement vehicle.
They are a tool.
They are a tool.
Yeah.
And when used in the right place, they can be the best tool for you, maybe, or maybe we should be doing pre-tax, but understanding the options that you have within a Roth and conversions and all that can really set you up for retirement.
Couple
Rex?
areas that we didn't cover
Yeah.
that I don't know that we necessarily want to circle back on, but we didn't cover about talking about Roths for a first-time home purchase where you haven't owned a house for 2 years, or for education purposes, other ways to utilize the Roth. And so Brandon, you might expand on a couple of those for just a second.
Yeah. So there are other ways to access a Roth IRA.
Tax free.
Tax free. Okay. Yeah. Well, and so your contributions are always tax free, which can kind of get you there in a lot of ways. The other thing is 529s is a recent change, but it used to be that a 529, if you made a contribution to that and then your kid didn't want to use it for college, or maybe they got a scholarship, and you had this big 529 balance, you were stuck with it. You could give it to a sibling or to a grandkid or pay a penalty and take it out. Now you can do a conversion once in a lifetime. You can do a conversion up to, I believe it's $35,000.
Is it? Because can you have multiple 529 accounts? So it's like once per account?
Yeah.
Okay.
Yeah, you can.
Yeah. Okay.
But that conversion is just one conversion to a Roth IRA.
Yeah.
And you can move that over into a Roth IRA, which can be really beneficial.
And it's just one time during your lifetime. As far as
I was just saying, if you had multiple
conversion.
529 accounts, you
can put them together.
You can do one, and then a couple years later do another one if you don't.
No.
Okay.
So if you're converting it to the Roth for yourself, you can only convert it to yourself for a Roth one time during your lifetime.
But you have multiple 529s.
You can have multiple 529s, right? So let's say I have 7 kids. Let's say I have 7 529s, right?
Yeah.
Let's use that as an example. And let's say, for the sake of an extreme argument, I've got $100,000 in each of those 7 529s. I can only convert $30,000 of one of those, or $4,000 from each, a combined, $35,000, right, into a Roth IRA for me.
Okay.
I can't take $35,000 from child A and $35,000 from child B.
Okay.
Okay.
But it's a great. We have a lot of people that want to do like Roth contributions for their kids, right? Because they're like, man, I can put this in, it'll grow tax free, and they're right. But the catch to doing a Roth contribution for a kid is it's capped at whatever that child's income is for the year. And a lot of kids aren't showing income, and so you can't do a Roth contribution for them. However, now that we've got this 529, you don't need income as a kid, right, to give them a 529 contribution. So you can fund a 529 and then later just convert it over to Roth, right? It's growing the whole time.
For the child. So Rex, you could conceivably take all 7 529s and convert them into Roths for each child.
So I could do that and then move them in. There's again a couple of some details that matter in there, dotting the I's and crossing the T's. But essentially on those 7 kids, if I change so that each of them is the custodian of their own 529 and made those modifications that needed to happen, then each of them could convert $35,000 out of those 529s into it. Now, I hope my kids don't get the wrong idea.
I'm just trying to help them out.
There's not a pile of money waiting for you. So let me just clear that up really quick for them. Okay, so there's not any confusion. Yeah. I think on the first-time home purchase, there's limits, right? I think it's $10,000 that you're allowed, and you can't have owned a home for the last 2 years. Same with education. So they're going to put limits on these. But if you need just an extra nudge for that down payment, or you need an extra nudge to finish up your college or something like that, then the Roth IRAs can fill that gap for you.
Yeah, withdraw up to $10,000 penalty free for the first time home purchase.
Oh, that's not bad. Okay.
Yeah.
Very good. Rex, anything else you want to wrap us with on Roths?
No, go fight win.
Okay. Thank you for listening to this episode of Through the Pines. You can watch and subscribe to us on YouTube at Through the Pines. You can like our Facebook page at Pines Podcast and follow our Instagram at Pines_podcast. Again, this has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.
Yay.